in times like this where bonus phase down, inflation's high, things like that, this is where the true operators appear in the space and thrive in the space, because they're the ones searching through thousands of deals to make sure it's the right fit and you're going to generate the right returns. As where, probably in 2017, that 1,000 number probably decreased to a couple hundred deals you had to look to find what works, right? So it's just a lot more work to find good deals at this point with it. But like you mentioned, 100% bonus could be back on the table this year. Yeah, I would say tax law change is probably pretty high at this point. Back in February, both the House and the Senate passed budget resolutions. So basically found ways to pay for the bill, right? So right now they can get into what's called a reconciliation process. And if they're able to do that, the one big beautiful bill, I believe it's called, if they get through reconciliation, it could be passed with a simple majority vote.
This is my time. I'm on the right.
Hi, I'm Kyle Stevenson, and you're listening to the Assets and Orthopedics Podcast. In this forum, we hope to educate medical students, residents, physicians, and other high-income professionals on the power of investing, especially in real estate assets and syndications. We want to help providers gain financial intelligence with the hope of earning financial freedom. Please listen and learn so you can spend more time doing what you love with who you love. Enjoy the podcast. Hello and welcome to the Assets and Orthopedics Podcast. This is your host, Kyle Stevenson. I'm excited to introduce you all to our next guest, CPA and cost segregation extraordinaire, Mr. Craig Fouts. How we doing, sir?
Doing well, Kyle. Hope you're doing well. So happy to be here and excited to get into cost seg and everything else on the fun side of the tax side of real estate.
Absolutely, man. Yeah, we can nerd out a little bit on some taxes. I think anybody that's listening that is involved in real estate investing has at least some, maybe not some knowledge of it, but they have some interest in what we can talk about with taxes. So appreciate you being on. Welcome to the show. Let me give a quick introduction and then let you start us on your journey. So Craig is a partner at Align Tax Consulting and leads the cost segregation team, specializing in fixed asset consulting, including cost segregation studies, fixed asset reviews, and some other stuff. His responsibilities encompass overseeing Align's daily operations and mentoring team members. With experience managing over 10,000 cost segregation studies, ranging from modest six-figure acquisitions to multi-billion-dollar portfolios, Craig has worked across industries such as multifamily, office complexes, manufacturing, auto dealerships, healthcare, hospitality, sports stadiums, and large-scale developments. Even in complex tax scenarios, his expertise enables him to design tailored fixed asset strategies that maximize deductions for Align's clients. Craig has a bachelor's degree in accounting and management from Go Boilermakers, Purdue University, and is a CPA registered in Indiana. So what can we add to that? What can you add to it?
Yeah, absolutely. So appreciate the nice introduction there. So just a little bit about myself and my journey of how I got into it. Going to Purdue, by the way, Go Boilers, heading to the Sweet 16. Pretty excited about that.
And that's here in Indy too, right?
It is, yep. So might or might not be going to the game. Still trying to figure that out, but I'm sure I'll end up there.
Yeah, you will.
Of course I will, right? Yeah. But yeah, so, never, going through school at Purdue, had no idea about what specialty tax is like everyone else, right? And just fell into an internship at a local firm here in Indianapolis. Did an internship there, had a lot of fun traveling, going to see the properties, which is part of the cost segregation process. From there, and just really kind of fell into the world and had a great team there and had a lot of fun with it. And ever since then, just, been diving deeper in the world of cost segregation, ranging, and like you mentioned, working on some small rental properties all the way up to multi-billion-dollar portfolios. So, like I said, growing up, going to school, never thought I'd get into it, but happy I fell into it.
That's great. So you've been into cost segregation for a long time, huh?
Yeah, just over a decade now.
Dang, that's very cool. Okay. So, yeah, we're going to definitely get into that. We'll get deep into it. It's pretty sweet. I want to start off this episode just getting your thoughts on a couple things. I'll start off by just saying, a lot of people that listen, not just physicians. I've opened it up to, a lot of people that are high-income professionals, I would say. And most people are interested in real estate investing, of course. And I talk to a lot of physicians because that's my space. It makes sense. But they pay 40 to 50% in taxes. And then I go to real estate conferences where they're paying like 0% in taxes, right? There's a big dichotomy there. I've even talked to physicians that are paying some $500,000 in taxes. Another one told me he's paying $750,000 in taxes. And, we get it across the board. So, of course, this is important so we can minimize our taxes, right? As physicians, there are legal, ethical, and moral ways to do it. Tom Wheelwright, I talk about him quite a bit. He's Robert Kiyosaki's CPA, and he's the author of Tax-Free Wealth. He is known for saying that the tax code is a list of incentives where 99.5% of it describes how to lower taxes. And I know the tax code is like massive, apparently 3 to 5 times the Bible. And Kiyosaki talks about how it's not about how much money you make, it's about how much money you keep. And again, that ties into the whole tax game. So, do you agree with that? With the whole how Tom Wheelwright says 99.5% of it is tax incentives on ways to lower the taxes?
Absolutely, 100% agree with that. So, I think you mentioned it's 3 times the size of the Bible, right? I think the actual written tax code is somewhere just under 7,000 pages. But then if you factor in all of the IRS guidance, revenue procedures, etc., if I'm not mistaken, I believe it's over 70,000 pages of writing. So, people like to call it, I always like to call it like a black hole or a maze, right? But if you know how to get through the maze, know where to look, how to read it, how to and understand it, you are 100% correct. It is full of incentives. It truly is a deal where, they're incentivizing people to grow and invest in the economy, right? Well, the ways to do that are through different incentives of reducing your taxable income by whether it be different types of deductions, tax credits, whatever it is. Finding unique ways to be able to go do that, that is what the tax code is full of. So, and knowing where to look and how to find those things is where, again, experts in our space know how to go and do that for people. So, yeah, absolutely agree with that.
That's great. And you got to be resourceful, of course. So you got to find the CPAs that are resourceful, because there's no way you can know all the stuff that's in there.
Yeah, exactly. So, when we always kind of describe who we are and what we do as a firm, right? Like a line tax consulting cost segregation specialist, we know a ton about a small amount of the tax code. We know just a tiny fraction of it. As where a lot of CPA firms or general CPAs know a little bit about a lot of the tax code. So that's where we do work with a ton of CPA firms where, we work as maybe like a back of house or, an expert that they lean on to be able to help guide through the rules, because they can get very complex very quickly.
That's awesome, man. I mean, in our world, it would be like an orthopedic surgeon is a specialist that, the general, the hospitalists or the generalists will send their patients to, right?
Yeah, exactly. It's the exact same concept.
That's great. So I did have an episode probably 7-8 months ago, maybe longer. It was Ryan Carrier. He was a real estate CPA. So we did get into a lot of like basic stuff, I would say. And we can go from basic to advanced. We can do, go wherever you want to go, Craig, to help kind of lead us on this journey. But let's get started. So many investors have heard of cost segregation. I think it's becoming a more probably common term now that, with social media probably pushing more like real estate terms and things. But I would say that most people still probably don't fully understand it. Could you break it down, how it works, why it's such a powerful tool?
Yeah, absolutely. So, cost segregation, it sounds super fancy, but the concept is very simple. Under federal and most state taxes, when you buy, construct, or renovate a property, the property is either depreciated over 27 and a half or 39 years, depending on the use of the property. So for 27 and a half year, that's going to be your long-term residential. So that'd be your multifamily properties, your rental properties where you have long-term tenants. And then most of your commercial properties are going to be 39 years. So really why you're allowed to depreciate those properties, right, is buildings don't last forever, right? There's wear and tear on them. The windows go bad or flooring gets, worn out or whatever it is, right? The IRS allows you to take deductions based on the amount of obsolescence or the wear and tear of that property. Well, not everything at that property should have a life of 27 and a half or 39 years. And what part of the 3 times the Bible size of the tax code allows, right, is certain property is allowed to be in shorter live buckets. So that could be 5, 7, or 15 year lives. For I'd say probably a lot of the listeners, because I love listening to this podcast, is, your short-term rentals. I think it'd be a great example for this. So, your kitchen cabinetry or your carpeting or decorative lighting, those are different types of things that could be in that 5-year bucket at a rental property. So the process of what cost segregation does is it's a fully engineered study where we come in, we break a building down into its individual components. So we'll go through and account for the roofing, the walls, the flooring, you name it, right? We put a value to each of those different components and then put it in its correct depreciable life. So that could be 5, 7, 15, 27 and a half, or 39 year. And it all depends on the use of that different type of property. And there's a huge revenue procedure that shows you all the different asset classes based off of industry. And I can get into that a little bit too. But why it's such a powerful tool is it's entirely based off of time value of money. So basically, right, the general concept, $1 today is worth $1 tomorrow. Well, that also applies to deductions on your tax return.
$1 today is worth more than $1 tomorrow?
Yeah. Yep. So deduction today is going to be worth more than a deduction tomorrow, right?
Yep.
So what we can do is accelerate depreciation. So move it from that 39-year bucket or 27.5-year bucket, move into 5, 7, and 15-year lives. It increases your depreciation deduction on your tax return in the current year, lowers your taxable income, keeps money in the bank, right? But what you need to do with those to really truly make it worth it is reinvest those proceeds into some type of way where it's going to earn you more down the road. That could be paying down debt on your property. You can throw it into the stock market. You can reinvest in your business. Whatever it is, you want to make sure you're putting that money to use. So, you mentioned a lot of the people on social media where they're saying they're taking these savings and going and buying a Rolls Royce or something. Definitely want to debunk those different types of things. That is the exact opposite of what we would advise in terms of doing with your savings. So, a really easy way I like to describe it in layman's terms is you're getting an interest-free loan from the government, right? So you're taking all these deductions, creating tax savings today, and then you all have all this money that you will eventually have to pay down the road. But in the meantime, you can go put that money to work and, generate more income off of that.
Yeah, that's awesome. Yeah, use that money to build more wealth, right? I mean, that's how the wealthy are getting wealthier. If you see the nice cars and you think that's what you want, then you're mistaken. The sexiness is freedom, building wealth and setting yourself up for success later in life.
Yeah, and I think, something I think we talked about a couple of weeks ago is, real estate on the outside seems very sexy, right? But the things that make real estate fantastic and how to truly grow wealth and build portfolios are things that aren't sexy, like depreciation and taxes, right? It's all those different types of advantages that really matter that make real estate fantastic.
Yeah. Yeah, you're so right, man. And I would say the day-to-day stuff, real estate's not sexy at all.
No.
There's really not much sexiness about it. But what is cool is the April, when you get your refund or, minimize your taxes or if you extend in October, you see that and you get your taxes back. You're like, whoa, I just, minimize my taxes by certain percentage because of all this stuff. It adds up.
It does. It's funny too, the amount of people we talk to that maybe have started in a career like medicine or something like that where they're high earners and eventually shifted full time into real estate. I feel like it's, 25 to 50% of our conversations. That's how people get into it is they either had a tax problem originally or they fell in love with the process of, either running syndications or funds or whatever it is and just had a lot more fun and could see the wealth side of it.
Yes. These are the things in medicine we never knew anything about. We just expected that we had to pay a ton of taxes, but we're doing it because we love our patients and we want to, you got to work twice as hard because we don't find ways to minimize our taxes. So the whole bonus depreciation. So is there a scenario where you shouldn't, if you have a real estate property, you shouldn't do a cost segregation?
Yeah, there's a few different situations where cost seg is a bad idea. Number one, if you're not going to hold on to the property for typically around 3 to 5 years, what's called depreciation rate capture comes into play. So basically what depreciation rate capture is anything that you were able to move into accelerated life. So that'd be your 5, 7, or 15-year life, and you took bonus depreciation on it. You have to add that back into your taxable income in the current year at your ordinary tax rate. So I can get into the specifics of all that, but typically that 3-year mark for most properties that we see is where the payback happens with the cost seg study. So that's number one. Number two, really cost seg does not make sense unless you have taxable income to offset. So, in general, rental real estate is passive unless you meet a couple different factors. And, I listened to the podcast you had with Ryan. So we don't have to get, redo all those different types of rules. Yeah, absolutely. So if there's no different types of taxable income, whether it be passive or active, depending on your status, not a good idea either. Those are the two main things that we see. Sometimes the benefit could be hidden, tax exempt tenants and things like that. But those are really the more, for the type of people listening, would be the two things that affect them the most office.
Real quick on that, because you're talking about the caveats, which would be real estate professional status or the short-term rental tax loophole, which is, I don't know the specific number and code that is in the IRS, but with those two things, you're obviously getting that going against your depreciation going against your active income or your non-passive income. But what about somebody that's part of a limited partner deal, they're part of a syndication, and they work as a W-2 physician? The group that they invested in are going to do a cost segregation to give everybody that bonus depreciation. What can they do with that passive gain that they'll get? The passive depreciation that they'll get?
Yeah, depending on the syndication, it could end up generating a loss for that individual in that first, second, or third year, whatever it may be. With those losses, they just want to make sure it's probably going to be passive in that case, right? If you're not meeting. So just want to make sure you have different types of passive income to offset.
All right. So with the bonus depreciation, President Trump in 2017 significantly changed the rules for bonus depreciation by allowing businesses to immediately write off 100% of the cost for that year. And then when Biden came in, he's been phasing that out, right? So I think this year we're down to 40%. Am I correct?
That's correct. And then it'll be 20% next year, and then gone after that.
Okay. So how is that changing the mentality of how, we're just going to stick with real estate, how real estate investors think? And do we know of any, is that going to shift back, and what's the update on that?
Yeah, two great things there. Back in 2017, when 100% bonus came, completely set the market on fire. I think you saw just the number of transactions increasing, the size of deals increasing. It made a lot of different real estate deals work that probably wouldn't have worked in the past without bonus. And a big piece of that back in 2017, and it's I don't know if it's as well known to most people, but prior to then, only new constructions or renovations basically qualified for bonus. It's called the first use rule. Basically, you have to be the first user of that type of property to qualify for it. So they got rid of the first use rule. So basically, acquisitions started qualifying for bonus. So that made a lot of deals be great and fantastic. Now, with that being said, as bonus phases down, or has continued to phase down, a lot of those deals that probably worked back then aren't looking as good now, right? Because the returns just aren't there. So I saw a great thing. I forget where I saw it, but in times like this where bonus phase down, inflation's high, things like that, this is where the true operators appear in the space and thrive in the space, because they're the ones searching through thousands of deals to make sure it's the right fit and you're going to generate the right returns. As where, probably in 2017, that 1,000 number probably decreased to a couple hundred deals you had to look to find one that works, right? So it's just a lot more work to find good deals at this point with it. But like you mentioned, 100% bonus could be back on the table this year. I would say tax law change is probably pretty high at this point. Back in February, both the House and the Senate passed budget resolutions. So basically found ways to pay for the bill, right? So right now they can get into what's called a reconciliation process. And if they're able to do that, the one big beautiful bill, I believe it's called, if they get through reconciliation, it could be passed with a simple majority vote. Part of that bill has a few fantastic things for specialty tax. Number one, 100% bonus returning, which is awesome. Love that. And then number two, on some of the other specialty tax stuff like R&D, they're getting rid of amortization of research expenses. So they're going to make sure the immediate expensing's back. So a little bit different from real estate, but those are two main drivers that kind of go hand in hand with each other as a part of the bill.
Yeah, a lot of good things coming. Whether you're a fan of him or not, he definitely helps stimulate the economy, and he wants to do what's best for investors and big business, and really get the economy going. I mean, that's what he does.
President Trump, like I said, like him or not, is a real estate guy. So that's where his mind goes when he's trying to incentivize, right? So, and part of that is creating a lot of good things for the real estate industry.
Exactly. Yeah, I don't think anybody's going to complain about paying less taxes, right? I don't care if you're liberal or Republican. You're going to be just fine with that.
Yeah, exactly. Who doesn't like to pay less taxes?
Yep. Here's a good question that maybe should be saved for later, but I'm going to ask it now. For tax planning purposes, well, first of all, I want to go back because you did make a comment about how the market has really made it difficult for all operators. And so only the good ones will shine through. Only the great ones really will shine through and make deals work. And it's difficult. I mean, a lot of deals that penciled out 5 years ago are not penciling out now, right? So you really have to be a solid operator to get through these times. And it's good for investors. You passive investors that want to, find some operators that you trust. Now's the time to figure out who's actually making the moves, who's still, working, and it was able to survive these last 4 years.
Yeah, exactly. Yeah, you nailed it. So, it'll be interesting to see who thrives in the space and who doesn't.
What are some of the biggest mistakes that you're seeing investors make when it comes to maybe bonus depreciation, cost segregation, anything with taxes? Are you seeing some big mistakes, or people come to you and say, hey, man, I saw this on social media, whatever?
I think number one, we do get a lot of the social media questions saying, hey, I saw this can offset my W-2. And we have to have the conversation over and over again that, sorry, your two rental properties do not offset unless you meet these requirements. But then again, they look at the requirements and the required documentation that goes into it, and usually people don't want to do it. I'd say really it's crazy to me, but the lack of education about all of it. And it's like you mentioned earlier, it's growing in popularity. But for the most part, most of our conversations are just education based. So, we're always happy to spread the word about the benefits of it, whether they can benefit from it or not. We just like to make sure they at least know about the different types of incentives that are out there. So when the time comes up, we can help them. So, we're always happy to have those conversations, teach people a little bit. If we walk and have an opportunity with it, wonderful. If not, we just love to spread the word. So, I think a lot of people just are, in terms of mistakes, are trying to make decisions without being informed of everything.
Yeah, and the other thing that I've learned over these last, 3-4 years or so is a lot of people don't really want to pay much for taxes, right? They want to do the TurboTax or whatever simple, pay minimal. It's like when you really have somebody that's going to help you like strategize and really make an impact on your taxes, you're going to have to pay a little bit more money than just your standard, person that does your taxes at the end of the year or in April.
Yeah. I mean, having a trusted advisor is 1,000% worth it. When you get up to the level of income where you're trying to diversify your portfolio, whether it be with different types of stocks or you want to get into alternative investments with real estate, whatever it is, having that proactive tax strategist, whether it be your CPA, your financial planner who is pretty involved in that, having those experts there that can help guide you and point you to the right people in the right direction, critical. Worth every single cent, because in the long run, that wealth you're going to build because of those minute strategies you did year over year are going to accumulate well in high returns over time.
Yep. And have those conversations, the year before, like have 4 conversations in the prior year that you're going to file those taxes to strategize in, as a, instead of reactionary, you're proactive about it. Right.
Exactly. And, I always love to be part of the front end of deals too, because we can show what the effect is before they make the decision. Right. So at least whether they decide to do the deal or not, at least they have the information in front of them. Right. And we can help walk them through how it affects them. So, and a lot of people will just say, hey, I did a lot of this stuff over the year. Here's what happened in the past. Do what you can to help me, rather than, hey, here's what I'm thinking about doing. Here's some of the major investments I have going. What can I do to make this the most tax efficient, either structure vehicle, whatever it is you're doing there, to help minimize those taxes.
I would say most physicians that I talk to, they'll, text me, call me, say, hey man, we really want to get into the space. Where's the best way to start? I talk about, syndications. If you're a busy professional, then of course, just being a limited partner in a syndication is a great way to start, as long as you vet the deal, vet the operator, probably vet the operator more than the deal. So I would say a lot of the listeners are limited partners on deals. They may not have their spouse become a real estate professional. They may not get a short-term rental. So with that being said, we just talked about how they would get passive depreciation, which can really only offset their passive income. What's an example of passive income? And what would be the most common way for them to offset passive income? How about that?
You mean different types of passive income, or?
Yeah, different types of because they're going to get passive depreciation, right? They'll have the bonus depreciation from the deal, but they can't offset their W-2 necessarily, but they can still offset their passive income. What would be an example of that?
Yeah, absolutely. So I guess the easiest one, right, is rental real estate. That's naturally passive. But basically a lot of other passive things you're not called like active participation. So if it's not your main form of business, so whether you're making money on a side hustle you may have, right, or you do something on the side to help generate taxes or generate income, those are all different things that are considered passive. So essentially, an easier way, unless it's like certain stocks and things like that can be considered active, it's pretty much all the income on the side that's not your main form of job.
Yep. So an example of that is if you're in a syndication and, say every year you're like, I'm going to get into a new syndication each and every year. Well, one's going to pay out at year 3, the other one's going to pay out at year 5, the other one's at year, 6 and 8, whatever. So when you start getting some passive income from one deal, then one that you bought that year will give you passive depreciation that will offset that passive income, right? So real estate's really the best way to do it. Just keep getting into deals, and one deal will offset the next deal.
Exactly. So yeah, so when let's say it's in a 3-year fund, right? And when that fund comes up and you get your gain out of that, well, you're going to have to pay taxes on that gain, right? Well, a good way to offset that, you just nailed it, invest in another fund, right? That will create depreciation and some passive losses that can help offset that gain.
Yep. So I've heard this called the lazy 1031 exchange. Somebody else, I think Ryan, called it the 1031 exchange light. Is that similar to what we're talking about?
Essentially, yeah. So the most common way that we see what's called the lazy 1031 is, so with 1031 exchanges, there's some serious tight windows that have to be met. So basically with a 1030 exchange or 1031 exchange based off of the code 1031, right? You take a property, you sell it, and then the whole concept is you're going to trade that property for another property of similar nature. So it's also called a like-kind exchange. So it'd be, hey, you own a shopping center, you sell the shopping center, and then you trade that shopping center for one that's a little bit larger, because that's one of the rules, right? The basis has to be higher. Well, the benefit of doing that is you get to defer all of the gain that you had from selling that shopping center and roll it into the new property. So essentially, it's a tax deferral. Well, part of being able to do that is when you sell your property, you have 45 days to identify a new property that you want to buy, and then you have 180 days to close on that property. Well, like we mentioned, in the current environment, that is pretty hard to do. I forget where I saw it again, but 1031 exchanges are on like a 12-year low in 2024 and 2025. So it is way, way, way down. And part of that is, again, the current environment, and also being able to find those replacement properties. Well, a good way of being able to still defer gains on that shopping center you sold is 1031 or a 1031 light or whatever, lazy 1031. So instead of doing an actual 1031 exchange, you sell your property, buy another property, and then get a cost segregation study completed on that property, and you can help offset the gains from what you sold. It's a way more flexible way of being able to defer some of your taxes without you don't have to deal with those tight timelines, essentially. So the way the math works on it too, though, you still need the basis. So, the cost of the property be higher than what your previous property was.
Okay. Now, does bonus depreciation phasing out, doesn't that make the lazy 1031 exchange tougher?
It does. Yep. So it's the benefit is still there, but instead of creating a huge benefit in year one, creating losses, those are going to be spread out more towards your 5 to 7 to 10 years. So you're still going to have the same level of reduction in tax or for those years. It's just spread out at a longer period of time.
Yeah. And then another fantastic, not really an exit. So, you're thinking about the 1031 or the lazy 1031. You're like, man, I got to be in this property forever. And then when I want to get out of it, I got a 1031 exchange or I'll pay those taxes. I'll recapture. Well, there's another way to pull your money out, and that is cash out refinance, right?
Sure. Yeah, absolutely.
You could cash out refi when the market or when the interest rates, improve again. You could take a higher interest rate down to a lower, do a cash out refinance. And if I'm not mistaken, that's a tax free or a tax deferred play.
Yeah, I believe it's a tax deferred play. So full transparency, I'm not as well versed in those, but yeah, you are 100% correct. That's a great exit. One thing I do a ton more work in, that's a great exit play as well, are opportunity zones, which, if you buy and then hold for 10 years, it's basically a tax-free play. So there is no depreciation recapture on it when you get out of the 10-year hold. And then any gains you had with that property are all tax-free as well.
That's awesome. I need to get into more of those.
It's, in my opinion, that is the best tax incentive out there. So with those as well, the investing period is coming to an expiration with the sunset of the TCJA from 2017. So at the end of 2026 is when the investment period is set to expire. Hopefully they get extended with the new bill. That'd be wonderful for us.
Oh, yeah. That's great. Yeah, I'm sure for you guys, like, you're busier than ever when, if these bills come into play, then that's going to just ramp up business even more, right?
100%. So what we saw back then was, typically prior to 2017, the threshold for a cost seg study that made sense was typically around $1 million, $1.5 million, depending on the type of property. We saw that threshold basis drop all the way down to the 300-400s. So the amount of properties that opened up to be worth it for a cost seg study and create benefit was busted wide open. So basically the market just grew insanely. And then there were, on top of that, a lot more transactions going on because of it. So it was a great time, and we hope it comes back.
Yeah, absolutely. So I do get this question quite a bit. When real estate investors, even if they're just putting money in a syndication, they ask, how do they structure their entity, or is there a specific tax advantage to holding properties under an LLC versus just your personal ownership, your personal name?
Yeah, absolutely. So, the main reason for people to throw things in, we'll call them like propcos, property LLCs, whatever it may be, is, liability purpose, right? So it's protected from the rest of the assets. That is essentially the easiest way to do it. But then, you always want to be able to hold it in basically a pass-through. I would highly recommend never to throw rental real estate in S corp. It's a bad idea. It's a good way for taxes to backfire and increase on you.
That's good. Good advice. Yep. But ultimately, as a limited partner, aren't you pretty protected? I mean, maybe this is more of a lawyer question, but you're pretty protected as a limited partner, right? And you don't necessarily need the LLC.
Yeah, that's correct. So, as an LP and saying like a syndication where you're investing, really what you're at risk is for your own investment, right? I think everything else is going to be on the GP there for the most part, right? If you're getting to some smaller deals where you're in partnerships 50-50, there could be more to it. But mainly if you're in passively investing in a big syndication, you're on your own for your own basis, your own investment.
A couple questions on this one. If you've listened to any previous episodes, I'm intrigued to hear what you would think about well, first of all, are there some overlooked tax saving strategies that the common folk don't know about that sophisticated investors are using right now? A, and B, do you know much about the infinite banking strategy and how you can use that to invest in real estate and help save some taxes?
Yeah, I'd say for the first part of the question, there's certainly many of them that are out there that are not very well known at all. A great one that we work with a ton of developers on is 179D studies. So basically, if you construct or retrofit or renovate a property, you can get a per square foot accelerated depreciation deduction if it meets certain energy efficiency requirements. So essentially, the benefits of it flow through or mirror exactly what a cost segregation study does, but it's all based off of a per square foot basis on energy efficiencies. So, and the best part about 179D2 is it can work in conjunction with cost seg studies, 1031s, OZs, you name it. Those are all things that can work together. It's not an or situation. It could be an and or situation.
That's great.
Yeah. So then, the infinite baking as well. I'm familiar with the concept. I did listen to a couple episodes you've had on it. It's pretty cool to listen. So it's certainly a unique strategy. People should go after, if they're trying to generate or get into real estate and finding ways to generate capital.
So, do you guys, obviously you guys have a ton of, operators coming to you for tax advice and tax strategy and using you guys. Are you guys a resource for people that want to find deals to invest in?
Yeah, absolutely. So we have a huge network, right? Because that's who we serve, right? Our people investing in real estate deals. We work with a ton of syndications, funds, sole proprietor investors, you name it. If there's certain avenues that people are looking to maybe they want to go on a 50-50 partnership or they want to go into an opportunity zone. We have such a large network where we can point people in the right direction.
Yeah, we'll definitely get you more information for your company and yourself, and do all that at the end. And then on the show notes of the podcast episode, we'll put that out there as well so people can find you, because that's great. You guys are a big time resource for people.
We try to be. So we really want to be more on the advisory side and helping, like I mentioned earlier. We just want to spread the information, make sure people are aware of it, and get them pointed in the right direction. And then everything else will fall into place.
We're starting to wrap up a little bit here. And then at the very end, we'll go through 4 quick questions for you. But say you have a listener that's just starting out. They're just starting in real estate investing. They don't know much about anything. They've listened to podcasts or they read the books or whatever. What's one piece or a couple pieces of advice, of tax advice, that you wish that they knew from day one? And one that I'll say real quick is, I hear this term a lot, this phrase, don't let the tax tail wag the dog. Meaning, I guess you can really explain what that means, because we hear it all the time. And what does that mean, first of all? And then what's some other, a bit of advice that you can...
Yeah, I've actually never heard that phrase before.
No?
So, no.
Don't let the tax tail wag the dog. Like, in an investment, don't just do the investment for the tax aspect of it, right?
Right.
Because you get burned on the investment itself. So you save some money in taxes, but you got burned on the deal. So don't let the tax tail wag the dog.
Oh, I like that. So, no, that's fantastic piece. This is something because we work with a lot of small business owners. Don't let the tax decisions affect how you run your business. You run your business how you need to, and then we'll do everything on the tax side to help you as much as possible. So that's a great one. I would say on the tax side too, don't try to be an expert yourself, right? Say you are a surgeon or, a physical therapist, whatever it is, that is your specialty of expertise. And I hope, it'd be like me trying to say, hey, here, I'm going to come in and fix your knee, right? So, you stick to what you know and then lean on experts to stick and lean on them to let them do what they do. So, expand your network as much as possible in the tax world and lean on the specialty or the niche services or your CPA to get you the advice that you need to get. So, don't try to Google things. Don't try to master it yourself. Expand your network, meet as many people as possible, and then all the information will come to you naturally.
Yeah, that's awesome. Yeah, AI is becoming, a really popular thing, right? And it's almost like you can ask it anything. It's hard to know, who to trust. Like, do you trust AI? Is it like Wikipedia where, you shouldn't just use that as your resource, right? Like, I would much rather use a CPA that knows what they're doing.
Yeah, use the CPA. So we've joked around and asked some technical questions in the AI, and I'd say 9 times out of 10, I'm sitting there shaking my head because it's not right at all. So no, I'd say trust your CPA, trust the people who've been in the industry and understand how it works. So It's with the tax world, I would say it's not like just being book smart. It's truly almost like an apprenticeship where you learn from the person that has either mentored you or the people you've been around to show you how things actually work, because it is quite different than what the concept or what we'll say general perception of it is.
Yeah, I mean, I think it's like anything, it's probably more of an art than a science, right? There are many different ways to go about every situation.
It's more than plugging numbers in, which is what most people think accounting is, right? So, a great example of that is, advising a client on becoming a real estate professional. Well, it's well known, it's not written in any IRS documents or tax law, but it's very well known as a very highly contested area under audit. And then it's one of those things too, where here's the information that the documentation you need to have to be able to protect yourself doing that, right? Unless you were on the job and understanding and learning that, or going through a situation where that happened, you wouldn't know about it. So, it's just those types of things. You just need to have that experience and let people guide you.
Yep. One last question before we get to the final four. Somebody that's just getting started in this stuff. I mean, again, real estate always sounds fun and exciting, but there's gas and oil. There's probably some other, tax benefit strategies that you can use. Why should somebody do real estate investing as opposed to gas and oil? Or do you know much about gas and oil?
Not a ton. We've done a lot of depreciation work on gas and oil stuff. In terms of the benefits, not as familiar. I would say the one thing I love about real estate is it's the only asset that appreciates in value, where the IRS allows you to deduct the cost of it being reduction in value. It's cool. It's the greatest tax benefit in the world, where you can, basically write off something that's technically losing value, but only appreciating value. So
that's a good point.
Yeah. Right. So it's something that's really only going to rise in value if you make the right investments, right? It's a very easy and quick way to build your wealth.
Yeah. I like that. Yeah. That's what confuses people, I think. It appreciates in value, but it also depreciates. How does it appreciate and depreciate at the same time? It's that paper loss.
The paper loss, yeah.
All right. So in closing, I like to ask my guest 4 final questions. What book are you reading right now?
All right. So I'm currently reading Into the Wild. The story of, the kid, right, went to Emory, journeyed across America and ended up in Alaska. So just for the sense of adventure and, want to get out into nature.
Into the Wild. Okay. We'll look into that.
So there's a movie that was made about it, but yeah, so it's a pretty great book. So I'm a huge hiker, love being in nature. So it's been pretty cool read and fun to read.
That's awesome. Okay. What advice would you give to your 25-year-old self?
Invest in the real estate. So back when in my early 20s to mid 20s, I did what was natural. And with the money I did save, I put in the stock market and tucked it away in my investment accounts. And looking back on it, I think there was multiple opportunities I could have invested in real estate, and I passed on it because I thought it was too scary. Looking back on myself, I should have done it.
That's great. Yeah. At least you knew about real estate at the time.
True. So that's all. We're going flipping cost seg studies, and I saw what it was doing for people. And I thought it was awesome. I just didn't know how to get into it.
Yeah, that is cool. That's something you don't think about. I mean, you were seeing those come across your desk, right? You were helping these investors go through it at a young age.
It was cool. And, when we prepare studies, my partner, Justin, and I always like to have, it's almost like a competition for ourselves, where we love to be able to see the actual benefit at the end of a study of what is actually being brought to the client. It is so cool to see how it affects them tangibly as it flows through their returns.
Yeah, that's amazing. Amazing. All right. So what is your definition of wealth?
Ooh, all right. That's a great question. I think my definition of wealth is just not financially, but being happy in all aspects of your life. So, being happy with who you are as a person, maintaining and building relationships that you care about, while also pursuing either a career or whatever it is that you do for your finances that you truly love. I'm a big believer in if you are doing something you love and truly care about, the tangible money wealth comes on its own.
Yep. I love that. That's good advice for the young buck. Proverbs 11:25 states, "A generous person will prosper. Whoever refreshes others will be refreshed." If you can make a big impact by giving back, what would you or have you focused on?
Yeah, absolutely. So I try to do a lot of work, and it's funny, you actually had recommended someone to me about helping young people get into accounting and how to either pass the CPA exam or what the industry is like or how to be successful in the industry. I love to help mentor and develop and grow people both personally and professionally. So I do a lot of work with that throughout the community. I have a lot of contacts from both past careers / jobs, as well as just people I know around Indianapolis and Atlanta where I used to live. Continue to help grow and develop them and just maintaining fantastic relationships out of it.
Dude, that's awesome. I love that. Mentorship is big. Obviously, you grew up in the space and people had to educate you on things. So you're educating the next generation and making accounting fun, right?
That's what they say, right?
But real quick, success is what you get. Fulfillment is what you give, right? So giving back is awesome to help that next generation. I love what you're doing, man.
Yeah, back at you. So it's been wonderful to be on the podcast. Love that you're trying to spread the word, starting out right with physicians and other types of doctors. Now you're expanding your network. So it's cool. I love when the videos come out and on all the different concepts and cool things that are going on in real estate that you can help spread the love with. Yeah,
we appreciate you. Thanks for coming on the show, Craig. Align Tax Consulting. Where can people find you guys?
AlignTaxConsulting.com. And then we also have, all the different types of social media, LinkedIn, Twitter, Facebook, you name it, all under Align Tax Consulting.
Align Tax Consulting. That's great. Let's pray that Trump gets the bonus depreciation back to 100%. And let's save some money in taxes and continue investing in real estate.
Absolutely. So from the great words of Trump, I love depreciation. So thanks for having me, Kyle. It's been a wonderful discussion, and hopefully we get to do it again soon.
Let's do it. Thanks, Craig. We appreciate you.
This is my time. I'm on the rise. Can't hold me down.
Thank you for listening. If you found value in today's podcast, please leave a review so our community can continue to grow. If you would like to stay connected or receive a copy of your free investing ebook, please go to www.sharpinvestmentsllc.com, and that's sharp with a P as in professional. This is not financial or tax advice. Please consult with your financial advisor or CPA.